So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys? And welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Brian Wagers. Brian, a partner with Elevate Commercial Investment, has served as the sole sponsor on over 600 units, 14 different deals, and 12 different exits in Northwest Arkansas. Since partnering with Elevate, he has been involved in $223 million worth of apartment transactions and over 2,300 units in Texas, Florida, and South Carolina as a general partner. Brian's primary focus is continuing to place private, institutional, and preferred capital into strong risk-adjusted projects in the multifamily space. Brian, welcome to the show.
Hey, thanks for having me on, Jonathan.
Stoked to have you. Always great to have a fellow Raise Master on. We were just chatting offline about how strong of a group Hunters put together. Seems like we're only partnering with each other now, which is awesome. But before we get into the weeds here, I know you guys have been plugging right along despite the changing economic conditions. Kind of take us back. We alluded here, you kind of did your own thing in the beginning. Take us back to when you discovered commercial real estate and kind of what's led you to where you're at now.
Thanks again for having me on here. And good to talk to another Raise Master. I think actually, before we get in that, the first time we met was at the IRREC. We were watching the Bengals playoff game.
That's right.
It was in between sessions. There were some groups out there, so we were out there. You were cheering for my Bengals there. I forget who they were playing, but
that's right. I do remember that. Yeah, I'm not a Bengals fan, but I do like Joe Burrow. I tend to be more, I'm a Philly sports fan, grew up near there, but I tend to latch on to players who I want to see do well. People have a good work ethic, good mental focus, like Joey B. So yeah, I'm rooting for him for sure.
Yeah, Joey B is a man. Hard not to. Yeah, so that's where I was born and raised in Cincinnati. I went to University of Kentucky for college, got my economics degree there, jumped into the sales force right out of college. I wanted to be a personal financial advisor, but no one would hire me. I was too young. I didn't have a Rolodex of high net worth people to call for them or families to insure them to. So I jumped into the sales world. I did really well there. I was kind of had my head down for about 3 years and just growing my book with a sales organization. And then I was maxing out my Roth 401k contributions at the time. And I knew I wanted to do something more with my earned income. And it was either the stock market or real estate. And I saw the stock market as quick and easy and, mistakenly went into that route and tried to play some individual stocks and speculate. And I lost some money there pretty quickly. And I was watching it every day as if I had some sort of control over what it was doing, and I really didn't. And the second road led me to real estate. So I got a single family home pretty quickly after that. I dove in on the Bigger Pockets education and read every book I could on rental property investing. And that first real estate property was doing well. No 4 a.m. toilet tenant horror stories or anything like that. It was just the guy actually paid me the first of the month. He paid me $950. My rent was $450. I managed it myself. There was no headaches at all. And it was just this is going to be way too, what am I going to do? Buy one of these a year for the rest of my life to really get where I wanted to be at. So, I wanted to stay in the real estate space, and I understood the fundamentals of rental property investing. And that kind of led me to multifamily. So, you have the scalability of commercial real estate, but the same fundamentals of rental property investing. And I understood that. So I dove in onto the multifamily space. Before I was in Hunter's program, I was in Michael Blanc's apartment program, and really dove in on his education. There was a couple others in the space, but really dialed in on that. And while I had that first single family home, I located a 12 unit here in my backyard. And I bought that, I think about 6 or 8 months after I had that single family. I still own that single family home before I bought that. I eventually sold that single family about 1 year after owning it, as I got this 12 unit. But from that first 12 unit, I then bought another 12 unit. I bought another 20 unit. Then I went back and bought a 7 unit, and then a 54 unit, and then a 72 unit, then an 82 unit. So I was buying these kind of small, medium-sized apartments, kind of under the radar of the big players, but it was in my backyard and something I can control. And I was building up this portfolio where I was getting really good relations with lenders, starting to something I didn't do in the beginning was let my friends and, following know. At the beginning, I was just focused on getting deals done. And that was a lot of just family that was getting in. They were the kind of the equity. And I put my own equity in some of my deals, and then did a little bit of seller financing on that 20 unit. So I was able to retain some ownership on that. So I did that for about 4 years, just picking off these medium-sized, 4 to 5 years of medium-sized apartments in my backyard and about 45 minutes south of me. Something that I think it was more about like comfort level. I could go get to the property if I needed to. I really understood the market. I could get my family involved on it. I knew the bankers, I knew the commercial, property managers and all that. So that's kind of how I got started in the multifamily space.
That's awesome. I love that you just were buying kind of a little bit of everything, small, medium. I guess 100 units plus equals large now. I don't even know what qualifies anymore. But so your parents, your family was you said your family was the equity, right? So you were raising money. It was just from close family.
Yeah, it was my girlfriend's dad at the time was one of my bigger investors. So it was a lot of convincing. They had been in the 2008 crash, and they owned a bunch of single family homes free and clear, and they were very debt adverse. So it was pretty a big leap to get them involved. So I had done the single family home, that 12 unit I had done with some personal money, and I did the 20 unit with seller financing. So I was starting to build a little bit of track record with myself by doing this, by the small deals. So they saw that, and I kind of went to him with, hey, here's worst case what the property will perform, and here's best case. Worst case, we're getting pretty close to break even, but best case, you're crushing what you're doing in the stock market and better than any of your single family homes that performed. And I'm the one doing it. You focus on your construction, commercial business, and I will do this and grow it. So it took a lot of convincing, because they had been through the 2008 crash. They were super debt adverse, and I had to, educate about how leverage can be if you're smart with leverage, it can be a really great thing, especially with real estate. So it was a little bit of training there. And so I got him on board, and we invested, quite a bit there. And then he kind of let some of his business colleagues know. So we started to do that. And then I started to let more of my family know. And some of my neighbors actually got involved in investing too. So it was kind of word of mouth in the beginning.
That's awesome. I love it. And have you exited some of those, or you still have that whole portfolio?
Yeah, we've got maybe a couple hundred units left. I exited my personal portfolio. I had a 7-figure gain on that for my personal portfolio, which was super helpful, like awesome equity that I was able to build up, a lot of really good experience. And now I have this equity that I'm reinvesting in my syndications, where I can invest alongside of my investors too. And then we've exited some of the deals that I've done with him. We've exited and made him, millions of dollars, and doubled and even tripled his return on some of those. So which is great, makes the relationship a lot easier too. Maybe he wouldn't have gave me his hand of approval so easily if I was not good at what I was doing. But luckily, we bought in good, and we executed our business plan pretty well. So yeah, we held a lot of those for about 3 years. I would say the average hold 2 to 3 years on those. So
That's awesome. I love it. And obviously, speaks volumes to your understanding of, you know, the business, how it works, executing, which of course, now you have an investor, a group of investors, right? When you're 3Xing someone's money, they're probably pretty eager to invest in your next deal. And that's obviously led you to now you're with Elevate. I imagine that partnership came about by just wanting to do bigger deals.
yeah, syndication was always in the back of my mind. I knew that like that's something I wanted to do. But for me, what I wanted to do was kind of create a track record for myself and create a track record of these deals before I went and asked for more people's money. So I wanted to like make sure I understood it and had experience doing it. And it being in the background of my mind, I probably about 2 years ago, I was starting to make offers on some of the same apartment complexes that I had already made offers on. So I knew I was like, okay, we're getting close to the timing that I'm going to really need to like lever up. I'm in Northwest Arkansas. There's only so many doors here. I'm coming back across some of the same apartments that I've already made offers on. And with it being in the back of my mind, I knew that, for the long-term plan for me, I think the capital raising was what I wanted to focus on. I like talking to investors. I liked especially talking to business owners about how to grow their money, and them focus on their own projects versus go chase down deals and chase down, management. And then I also like the fact that I could do it anywhere. I'm here in Northwest Arkansas, but I can go raise on a deal in Jacksonville, Florida, or Dallas, Texas, or Columbia, South Carolina. So I really liked that aspect of it. And for me to find an operator that's doing this on a bigger scale than me and more experienced, I knew that that would probably be the best value I could bring. Yes, I have this experience with asset management and construction management, but for me, not being boots on the ground in these different markets, I don't think that would be as valuable for me to someone else. So I was started to search for operators that were doing what I was doing instead of 20, 30 doors, hundreds of doors at a time and getting to that 1,000 unit mark. And that's when I found George. George, if you guys know, George is pretty active on social media, Jorge Abreu. I saw what he was doing, and a lot of it was on the construction side, which really intrigued me because it's one thing for me to walk a 12 unit and see a crack in the side of the building, but to walk a 400 unit apartment complex was a little scary for me, so I wanted someone who had that construction eye and that kind of CapEx experience to partner with, because that can be huge ticket items. So I really liked, he had that brand skin in the game and then the operational part. So I actually reached out to them. I was like, you guys are growing really fast. They didn't really have anyone that was growing their capital like that I thought they could be. And, I think it was really good timing as far as where I was growing in my trajectory and where they were growing. So I came on as a partner. At first, I didn't actually come on as partner. I raised for them for 3, maybe 4 deals before we actually were like, okay, instead of the co-GP model, like let's combine forces here, and not just because before that it was just Wagers Capital. It was I created an LLC and did the Wagers Capital. Before that, those first 500 units, to speak on that, I didn't have a business card. Those first 500 units, I didn't have a business card. I didn't have a website. I wasn't worried about like my brand image at the time. I was just trying to do deals. And my wife, actually, I had her join a program that was like about building a platform, and she helped build out my website. She helped me do business cards, book me on some podcasts to really start that outside network growing. So from there, we did those first couple of deals that went really well. Communication went well. I was able to communicate to my investors what was going on, and we were able to execute on those. So then we partnered up officially earlier this year.
Nice. Well, congratulations. That's awesome. And now obviously you get to just primarily focus on capital raising, which is obviously your superpower. And so let's kind of look at now, right? So obviously you guys are still doing deals. We're talking offline. You've got one already about to close, right? And then about to put another under contract. Is that
Yeah, so we have one that's about to close, another one that's under contract and closing in January. So we have 2 deals that are set to close right now.
So obviously, right, a lot of things changing economically. Potentially, it sounds like at least one more rate hike this year. You know, the big question is, what's your conversation like with investors right now, at the retail level?
Yeah, for sure. So I think a lot of them are, at least 3 months ago or 4 months ago, when this interest rate environment first happened, a lot of them were kind of scared. Like, so that we had a big raise, $75 million deal in LaPorte, Texas, 350 unit A-class property. Earlier that January, February, we had a couple deals. We would send out emails and everyone was like, boom, okay, let's do it. Let's go, oversubscribe. But this one, we'd send out emails and maybe a couple people reach out, but it was a lot of hesitation for sure when it first happened, and people were unsure what was going to happen. We were unsure like 100% what was going to happen. Hard to have a crystal ball. So it was a lot more getting on the phone with investors, letting them know we're still sticking to our underwriting. We're not, just because we saw 10 to 20% rent hikes, we're not going to continue to see those same rent trajectories. And maybe we do, but we're not underwriting for that. We're underwriting for interest rates to continue to rise. We're just having to be stricter on our underwriting. Saw a lot of deals retrading during that time. So you get under contract for 64 million and then you end up buying it for 60 million because those interest rates happened during the deal. But I think that has calmed down a little bit now. We know where they went and we kind of know where they're going. I think it's more like, yes, we are kind of in a recession. How bad is it going to be? It's not going to be, in my personal opinion, an 2008 recession. I think more maybe a vanilla recession, more or less, something that's, it's definitely a different environment. We're not giving $1 million houses to waitresses and waiters. We still have a housing need. We could start swinging hammers right now and still not fill that need for affordable housing or housing period. So it's a totally different environment. And I think just having those conversations with investors, letting them know how we're looking at the market, I think underwriting is more important than ever right now.
Absolutely.
And what you're assuming. So, to the investors that are listening, or even the operators, that, you want to look at your sponsors' underwriting assumptions. What do they assume? How has the property performed? Obviously the past 12, 24 months, but what are they assuming that they're going to do with the property? And, how conservative are they with it? So those are the conversations that we're having. I think another layer of insulation is these multifamily syndications. We're in 5-year business models. We're not fixing and flipping houses. We're not in it to flip it out in 3 to 6 months. The business model is built out to ride out any sort of, down cycles or up cycles. So you're not forced to sell in the middle of recession. So just making sure you're underwriting for that, I think, is super important.
Yeah, absolutely. I love that. A lot of really great insight there. Big thing is, just helping investors understand that, like you said, we're not flipping houses. This, 14, 16, 18 month full cycle deal phase is gone, right? That happened in some markets, and, and you were able to 2x money really quickly, but that's, we're back to the business of commercial real estate acquisition, 3 to 5 year hold, actually having to implement a true strategy. And, along with, that also comes, obviously understanding who you're partnering with and all of that. Are you guys partnering with other operators, or is everything in-house for you guys now?
We've brought a lot in-house. We still do partner with other operators, but we do, I'm obviously on the capital side. We brought Justin in for analysis, director of acquisitions, and we brought on full-time asset manager. So we're pretty vertical, and construction is in-house for us. We have J&T Construction. So we're pretty vertically integrated, but we do bring on other we want to have full control over the deal moving forward. We want to be the majority operator, but I talked to you before. We're partnering with another Aspen and the Raise Masters program. So sometimes we have partners that get access to really good deal. They might find a deal and they might be local to the deal or have local advantage. So we'll partner with them in some form of fashion. If they can be boots on the ground partner, or if they source a deal, then we'll partner with them. And then sometimes we have equity partners come on too. They've got a lot of investors. They don't want their investors' money sitting on the sideline just because they can't do a deal personally. They want to still serve their investors by putting their money into a deal with someone. So we partner with guys like that too. I think that's important to success as you're growing.
Absolutely. Yeah, you can't be afraid to partner up. Obviously, now, especially like I said, it's very important to know your partners, kind of vet them, understand, track record, obviously. And you guys obviously have that, right? And everybody across the board does. One thing I want to switch to now is the institutional space. You're obviously plugged in with institutions as well. Is the breadth over there any different than retail investors?
Yeah, it is. It's a lot different. I mean, maybe not a lot, but it is different. I think there continues to be hesitation from the institutional investors. A lot of them are actually sitting on the sidelines until January. They want to see how the end of the year shapes up, unless they had something that they've been in conversation right now. A lot of them aren't looking at new deals until January. It's from some of my conversations recently. But we do have some institutional investors that are still investing with us. We have some, like the deal that we have under contract right now. We have an institutional investor putting $10 million into that. So they're just getting more granular on, very selective on what markets they'll go into, what kind of underwriting they're looking at. They like assumable loans a lot right now. That's something that some of the more institutional investors are looking at. They like that when we can get in on a loan.
Explain an assumable loan for people who may not understand the difference.
Yeah, so assumable loan is a loan that was already set up by the existing operator or developer, and they usually it's either Fannie Mae or Freddie loan, 30-year loan that's usually a 10-year term. So you had buying the property, instead of going out and getting a new loan and re-leveraging that, you can actually take over the existing loan. So with the interest rates right now, what some of the assumable loans that we're looking at are in the low to mid threes. So if you can come in on that and maybe get a bridge debt or get an institutional investor to put in some preferred equity, your blended rate is a lot better than what you would get from a new debt. So they like the assumable loan also because it's low leverage too. They've paid down, or it's usually compared to your new purchase price, it's somewhere between 50-65% on the leverage. So that's just a loan that you're taking over that the existing operator has.
Yeah, that's a huge point right there. And thank you for that explanation. So that was one thing I was going to ask, and it sounds like the answer is yes. You guys have decreased your leverage, and I know lenders are kind of almost forcing that now as well. So are you guys trying to get into that 60-65 range?
Yeah, I think it depends on the deal, and from the lending perspective, I think anywhere 60, 65. I mean, some deals we're looking at 75. I think it really depends on it. We're looking at A class or C class properties. We buy, anywhere in between those. We like A class a lot right now when we can buy directly from developers. We found some 5 years ago, asked me if we would look at A class, I would say, I only buy value add apartments. This is what the A class is, just where the rich park their money and they just want it to, have something that looks nice. But we found kind of this opportunity where we can buy directly from developers. stabilize expenses. They're builders. No offense to them, they're not multifamily operators. They're really good at building, but they're not so much good at operating. So they're just trying to get these properties leased out as fast as they can so they can cash out and go build the next one. So you're seeing a lot of concessions there. You're seeing, they're giving away iPads or, rent, low rent to just to get the doors filled up. Spending a lot of money on marketing to market their property so we can come in, stabilize expenses and push those rents that they weren't necessarily doing. And then we can add little tweaks like covered parking, reserved parking, smart features on the property to justify more rent or other income on it. So we've really liked that the past 18 months. They've performed really well for us. And I think especially in this, when you have this environment of people that need a place to live but can't necessarily afford their dream home right now or don't want the right one, but they still want somewhere nice to live. So I think it's a good business model, especially when people are working from home now too. They want somewhere they can work from home that's, if they're going to be there a lot, that's a little bit nicer. So, but that's not to say we won't buy C-class properties anymore. We still look at that. I mean, we have in-house construction, so it makes it easier for us, but the spread between C and A class has definitely gotten smaller. And if it depends on if it's the right market, right median income, that's definitely something we're more bullish on. And I think equity and capital is starting to like that more too. So something we're seeing recently.
Yeah, absolutely. I think the biggest shift was when you really started to notice, like you said, that spread between the C and A class really start to get thinner. You really started to see a lot more, especially because I know like the firm I worked with last year, they were just like you, right? All value add C class. And even they just acquired an A class. They're in different markets, but same exact concept, right? They bought it from a developer. The developer is basically, like you said, just heavy concessions, right? Sometimes 30-40% below market, just trying to get people in there, get it over, which is obviously huge on the acquisition side because that's just baked in equity right from the start that you just get to immediately come in. And then obviously, so when you are taking those over and you have some of those kind of marketing things in place, concessions, iPads, like you said, are you still honoring those for new people if they're like bringing up the ads that they saw?
So I think I kind of defer to my asset manager on that or our property management.
That's fair.
But I would say we are not we don't account to offer the same concessions. We'll definitely phase them out as quickly as possible without being, not just, hey, everyone's rent is $200 more now and there's, no sorts of concessions. So you definitely want to phase that in on your property. So usually on those A-class deals, you'll see lower cash on cash the first year or two as you kind of slowly take over the business plan. So it's definitely a gradual process there.
Absolutely. But very appealing to investors because you are able to offer some kind of cash flow pretty much from the start.
Exactly. Yeah. Yeah. It's a good vehicle and it's going to be around for a while. And another point too, is you have a little bit higher level of staffing that you can afford on an A-class property. You're working with a little bit higher level vendors on properties like that too, because the property itself affords it.
Absolutely. I love it. Well, Brian, this has been incredible. Appreciate your insight into the world of capital raising, obviously, where I like to, one of my favorite conversations, that along with economics, which I'm sure you're in that same boat as well. So
For sure.
we'll kind of wind down here. We'll jump to the final five. First question, best advice you've gotten from a mentor?
Don't get the shiny penny syndrome. Stay focused.
Yeah, that's a very good one. What is about your career that makes you feel like you're fulfilling your why?
I think I'm building a legacy not only for my future family, but for the people that I'm helping invest.
Awesome. I love that. Favorite non-real estate or investment related book?
Non-real estate? but investment, so
Yeah,
non-business.
yeah. So it could be business, just can't be related to real estate or investing. Self-help.
Think and Grow Rich is a classic
Classic.
that I like a lot.
Awesome. Love it. Yeah, that one has really stood the test of time, hasn't it?
Mhm.
If you could have any superpower, what would it be?
Fly, for sure.
Nice. Yeah, absolutely. Love it. Cool. Last one. What's the best way for people to get a hold of you and learn more?
You can find me on social media wherever you are. I'm on LinkedIn, Facebook, Instagram. Pretty active on there, talking about what we're doing and getting more active on all those. So find me there.
Awesome. We will link the website on the show notes and everything. Make it super easy. Brian, again, thank you so much. It's been incredible.
Great talking to you.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.